Bismillah ar-Rahman ar-Rahim. This is chapter 5, but in the book, in the textbook, is chapter 6. It talks about investment companies. First of all, the main learning objective. In this chapter, you should know about the main difference between the closed-end funds and the open-end funds, and to know about the net asset value. The net asset value is the price of the either closed-end funds or the open-end funds. We will talk about the different type or different classifications, categories of the mutual funds. And in addition to this, different fees that the investors pay during their holding period. Like the loading fees, exit fees, and 12b-1 fees. Why people invest in mutual funds? This is important. The advantages of the mutual funds. The main advantages of the mutual funds, in particular for the closed-end funds and the open-end funds. The strategies and policies of the mutual funds is important, and the active versus passive management, and I know you have an idea about the active and passive management. It was the first sentence in your exam. The factors that determine your investment in mutual funds, and the factors determine the price of the mutual funds as well, and how we compare the performance of the mutual funds with regard to the risk and return. Now let's start by what exactly means investment companies. The investment companies collecting money from individuals. Okay, from individuals. And generally individuals considered as small investors with little volume of money or little amount of money. So they channel these funds to the investment companies. Then investment companies invest in the mutual funds like close, open, etc. Let's go back and link between the difference between the investment companies and the portfolio, just to link the chapters together. If we have an individual investor with $1,000, okay, and he or she wants to form a portfolio, and this portfolio including 1/3 in stocks, 1/3 in bonds, 1/3 in money market securities. The question is, it's hardly to allocate your $1,000 into 3 different classes, because the prices of the stocks may be more than $100 or $200. If you want to include Google in your portfolio, it's hard. If you want to include British Petroleum, also it's hard. So the $1,000 when distributed into the different categories, so we will put 330 here, 330 and 330. The question is how you invest in bonds, and the par value of the bond is $1,000. How you differentiate in bonds when you know that the minimum amount that you can buy in the bonds is $10,000. So the individual, in this case, they don't have opportunity to invest in the portfolios. Instead of this, the investment companies have the alternative option to the investors. So they give the individual investors the opportunity to invest in mutual funds. So again, the investment company coming from the idea, giving the platform to the investors to channel their money through the investment companies, then investment companies, they do the business on behalf of the individual investors. Okay, so this is the main idea of having investment companies. So the investment companies are not a recent development, but were established in Britain back to the 1860. Okay, it's not a brand new business.
Yeah.
It's back more than 200 years. Okay, and in that time it was like trustees, and those trustees working on behalf of individuals, and they manage the investments, and they ensure this investment is directed to the right way and is properly managed and properly target the objective of the individual investors. In that time, it was well managed as it today. So these firms issued a specified number of shares and used the funds that were obtained from the individuals, okay, through the sale of stocks to acquire shares of other firms. Now, as we have the rock idea about the investment companies and the foundation of the investment companies, the investing companies, they're collecting the fund from individuals. Now, they channel these funds to the other companies, or let's say they invest in other companies. They invest in the other stocks, bonds, securities, foreign exchange, let's say in foreign currencies and other securities, in the money market as well. So for this instance, this guy pay $100, this $10, this $1,000, and this $1 or $10,000, this $2. So you observe the mutual funds or the investment companies accept the minimum amount of even $1 single to the investment. They have this platform to the individual investors. Then they form portfolios. But this portfolio is considered as either closed-end funds or open-end funds. And within the closed-end funds, we have many portfolios. And the beauty of investment companies, they have a huge volume of money. It means they are pooling the dollar or the euro from different resources, and they invest in different companies. And they have their own say in the board of directors of other companies. Because this is little money, and this, when they have a pool of this little fund, they can invest in different securities. So now, this is the investment company. They channel buying stocks, bonds, foreign currencies by using different portfolios. So now, instead of having $1,000, you may have, for instance, $5 billion. But this $5 billion is coming from $1 single from individuals. It means this guy with the $2 investing in portfolios. But if the guy with the $2, he has no option to invest directly to the portfolios. Okay, this is the main invention of the investment companies, and this is why we have very large institutions, and they dominate a significant number of companies in this universe. We have two types of investment companies. The first type is the closed-end funds, and the second type is the open-end funds. The closed-end fund has a fixed asset. So by buying and selling securities from the secondary markets, and with a fixed amount of shares. For instance, if they form a portfolio or fund with $5 million, okay, or 5 million shares. The 5 million shares is the total investment, or the number of shares which coming from the individual investors. Now, if one individual investor inside this business want to sell the stocks, so they buy and sell within the portfolio or within the mutual funds. So there is no increase or decrease in the number of shares. The number of shares in this case is fixed. In the opposite, when we talk about the open-end funds, is fluctuated. Okay, and depends on the number of buyers and the number of sellers. In the previous case with the closed-end funds, the buyers should match with the sellers. But in the open-end funds, it is not necessarily the buyer to match with the sellers. Maybe the buyer exceeds the sellers, and this way, or in this case, the value of the number of shares or the number of securities increase. When we have more sellers, the number of securities decrease. But this is not the case in the closed-end in funds. So why the investment companies or closed-end funds and open funds is important? Because of the net asset value, the value of shares. The net asset value is important for the investors because it is the indicator, it is the price of the units of the mutual funds. As you know, companies issuing shares and bonds, but the mutual funds issuing the net asset value. Okay, or is like shares, but it have a name of net asset, the value of these securities, known as the net asset value. So what it means, net asset value, and how we calculate the net asset value, it's a question will be answered during the presentation. The taxation. In the mutual funds, investors pay no tax, or the mutual funds pay no tax, because they are individual investors, small investors, and to encourage them to invest. But if they liquidate their assets,
they will pay tax.
Yes, it's a subject of taxation. So be careful in here. In either in dividends or the capital gains, no taxation is paid. But if they want to liquidate, in this case they will pay they have to pay the tax.
To encourage investment, then.
Yes, it's likely, and you know, it's just to remind you, when we talk about the tax shelters in the previous chapter, and I asked you in the exam about this. Okay, did I ask you? Okay, maybe in other exams. Okay, so professional management. In the mutual funds, they assign a professional managers. They have experience in financial markets, in money markets, in different areas, in investments. They have experience in the investment policy, in the investment strategy. So this experience you don't have as a small investor, as an individual investor. So it is a good opportunity for you to invest within or through the mutual funds. And as I explained, portfolio diversification. If you have $1,000, it's harder to diversify your $1,000. But through the investment companies, it's fine. You can do this. And relative to the fees, fees, and the taxation, it has a minimum charges relative to the other securities. Growth in mutual funds these days, as I read in the morning, the mutual funds is growing more than 20% in the last 10 years. I mean the net asset value of the mutual funds. The importance of the mutual funds, it's bringing the funds with a cheaper price. It means the company or the investment company is not its obligation to pay the dividends. It depends on the policies and the strategies of the business. And the beauty of diversification, they have different portfolios and they have different style fits the majority of investors. Okay? So they have some portfolios for the growth, some portfolios for income, some portfolios is like mix between income and the growth. I will introduce these things to you during the presentation. Let's go back to the net asset value. Look at the calculation of the net asset value. The value of a stock owned is $1 million. How we calculate the net asset value? Just remember, the pricing, the mutual fund is not similar to the pricing of the other securities like stocks and bonds. It has different calculations and is determined by the investment companies. Okay? So the value of stocks owned is 1 million. You bought, for instance, 1 million shares. The value of total assets, okay, is 2,500,000. The liabilities is $100,000. It's like the liabilities, like the management and then the net worth is just 2.5 minus 0.10. You have 2,400,000. The number of shares outstanding is 1 million. Okay, so then you just divided 2.4 divided by 1. You will have net asset value per share is 2.4. And based on this, investors determine the value of their assets. For instance, if you have 1,000 shares, your total value is 1,000 shares times 2.4. If you have $100, the value of your fund is $100, 100 shares times 2.4. So this is the importance of having the net asset value. And as you observe, the net asset value is determined by the assets and the liabilities. These two factors influence on the price or the value of your assets. If the total asset exceeds the total liabilities, then the net asset value will grow up. If the liabilities exceed the net asset value, then your shares or the price will go down. Okay? So we have two main parameters to determine the price of the net asset value. And based on the net asset value, they determine the charges and the fees and the 12B1 and other fees. Okay? Any question for the net asset value? I know this is new for you, but I think you should manage to understand.
دكتور مش انت حكيت انها بتقبل مثلا $1 و$2؟
Yes.
طب $1 و$2 ايش بيشتروا هدول اصلا؟ بعرف انه لو انت حطيتهم مع مجموعه بيجيبوا، بس لوحدها لو انا بدي اطلع حصه هذا بس اللي اعطاني $2
نعم.
ايش بدي اعطي؟
Yes. If you have an option to save $5 a month, okay, and you bought with this company, investment companies. This company depends on the cheaper price. You know what it means? Cheap costs money. It means your $2 is you say to yourself, how can I invest? But if you give this $2 to them, you are not expecting to have $1 million. Okay? So they not asking, you may not receive interest rate with this $2. But when you give them this $2 and they invest for you, you expect that your money is to grow up in the future. But for them, they think this is a cheap money. And you are not the only individual in this with the $2. Okay? So if you think we have million of people with the $2, you know this these funds last year, I think, or 2 years ago, they declared to open 5 billion as a closed funds. Within 2-3 days, people with $100, $10, they have this. You know this? Because take the alternative. The $100 from the point of view of the investment company. If you take the $100 as a deposit, you have to pay the interest.
Yes.
But in this case, I don't need to pay the interest. To me, as an investment company, it's good source of finance or source of funds. It not necessarily that's having $1 or $100. At the end of the day, the mountain is from small stones. So this is the idea of the investment companies, and they have the platform for the small investors.
Yes.
And we know some people are starting by $10, and now they have a wealth with $100,000. If you think you're starting when you're in your earliest age, when you are in your 18 years old or 20 years old, and when you become in your 60 years old, you will have $100,000 if you save, for instance, $10 a month, because money is accumulated. Okay, and there's a lot of the investment channels. Okay, so don't underestimate the one single dollar. And one more thing, the dividends, the investor, they have an option to reinvest the dividends. And this option is not available in the stocks. Okay? Be careful for this point. For instance, you pay $2, and after 2 months, there is a growing in the mutual funds or in the closed funds, or the company decide to pay dividends. You are, as a small investor, you have option to ask them to reinvest. How they reinvest? They buy from other investors. Okay, so today you have 2 shares. Tomorrow you have 4, 16s, and so on. Your wealth is growing up. So the net asset value is extremely important for the valuation of an investment company. For it gives the value of the shares should the company be liquidated. At this price or at this value, they determine the price, they determine the charges, and they determine the equilibrium price between the buyers and sellers. Okay? And it's important to know how they calculate the fees, or sorry, the fees. The fees in here is calculated in different way. Let's take this example here. The fees is calculated based on the offer price. Be attention here, please. Based on the offer price. And it has different techniques in the calculations. Let's take this example. For example, if the net asset value is $20, the net asset value is $20. And the loading charge, I will explain what the loading charge means. Loading charge is 5.75%. So what is the fees that we paid when we are buying or selling the security? Okay?
اللودنج تشارج هي الانترست ولا ايه؟
Sorry?
اللودنج تشارج هي الانترست ولا
Load, yes, not interest. It's like the commission. Okay. So the calculation of this, it has different way because it is as a percentage of the offer price.
yes.
As a percentage of offer price is calculated like this. Be careful because it will be subject of your exam. Divided, okay, by 1 minus 0.0575. Okay? Then you have 21.22. Now this is the price now. The offer price is $20, which is the net asset value. Okay? We will calculate the fees according to as a percentage of the offer price based on this equation. The offer price divided by 1 minus the fees. We will have 21.22. Now you pay the difference.
1.22.
Yes, you pay 1.22. This is the techniques of calculate the fees. Yeah, difference between the net asset value and the price deducted or adding the fees or the charges. This is the offer price. For the net asset value again is calculated at the end of the day. The net asset value is calculated at the end of the day. And in the mutual funds, they don't use market orders or the limit orders. Okay? They just tell the investment company they want to liquidate, and it is not necessarily to have the price that they're asking. Okay? Sometimes it's more than what they ask or less than. It depends on the closing net asset value at the end of the day. Okay? So please read it carefully. A lot of questions about these things. Okay? And this is practical things.
The liquidation depends on what?
On the closing price of the net asset value at the end of the day. For instance, if you're asking at 10 in the morning, okay, you tell them I want to buy or want to sell, then they at the end of the day they give you the price, and you don't have option to say yes or no, because in this mutual funds there is no limit orders, there is no market orders. What it means there is no market orders, you don't have the price declared in the financial market, and you see the price and say, okay, I want this price, or I want to sell in the market price. Sometimes it's little bit less or above. So this is this techniques is not applied in the financial in the mutual funds. You're just asking them, then at the end of the day they give you the price. Okay? Closed-end funds, back to the closed-end funds, have a fixed capital structure, as explained. 5 million, 1 million, okay? And they buy and sell in the secondary markets. Try to differ between the closed-end funds and the open-end funds. The open-end fund is not traded in the secondary markets. Closed-end fund is traded in the secondary markets. Okay? Just be careful. They have their own investments. I mean, in the open-end funds. they're collecting or they are buying shares from other companies, and they have their own calculations and they have their own system in trading. It's like they have their own markets. So shares are bought and sold in the secondary market. Shares may sell for a premium or discount from the net asset value. As I explained before, the price of the net asset value is determined by the total assets and liabilities. If the total asset increases, it means we
increase.
okay, and it's calculated based on the daily basis. For instance, if you buy today, it has a price today, and tomorrow it has different price at the end of the day.
According.
Okay, so in this case, the premium, if the net asset value for tomorrow more than what is in the today, it means you have the premium. If tomorrow is less than today, you have the discount. Sources of returns to investors when they invest in the mutual funds. Income distributed in the form of dividends. They pay dividends. But be careful in the tax calculation. They have different tax calculation than the stocks. As I said, the capital gains and dividends for the companies is not subject of tax. But if you receive the liquidate, or if you liquidate, it's subject of tax.
Yes.
Capital gains distributions. Well, you know what it means, capital gains distributions. You know what it means? We know dividends is distributed,
Yes.
but what it means, capital gains is distributed. Anyone can explain this for me? When the price is appreciated, I asked this question before. What it means? Capital gains distributions. Okay? Give you this. For instance, the net asset value is, let's say, for 6 months was $3. The net asset value today is $5. But you still the holder of the security. You may ask yourself, I will buy or I will sell to have the $2 difference. But in the mutual fund, you have an option to ask them the $2 difference to reinvest. So they keep $3, okay, as the value of your asset, then the $2 in. So this is the distribution of the capital gains. Okay, so it has different techniques. It is not as simple as I said. Okay, there are a lot of calculations. And the capital gains is related appreciation in the net asset value. Don't ask me what it means, appreciation, because I asked you.
Increasing the price.
It's a Polish, in the Polish market.
Yes.
Okay. Yes. The good of having exams, it means people, they understand more than, okay? A change in the discount and the premium. So we have different sources from the appreciation of net asset value, from the capital gains, from the income distributed, and from the change in discount and premium. This is for the closed-end funds. For the open-end funds, it has a variable capital structure. It's not fixed. Okay? You may start with $5 million and you may end with $7 million or with $3 million. It depends on the investment. Shares are bought and sold from the mutual fund, not from the secondary markets. And we will observe some people thinking it's from the secondary markets. And you will get confused between the closed-end funds, because the closed-end fund is traded in the secondary market, and open-end funds. Open-end fund is not traded in the secondary markets. It is trading through the mutual funds, through the open-end funds. Shares cannot sell for a discount from the net asset value. Okay? There is no discount here. And the price is not going below the assets, because they either decrease the assets or increase the assets. Now, talk about the different fees. Generally speaking, we have funds with the load fees and no load fees. Load, it means paying fees. No load, paying no fees. It's charged to investor when the shares are purchased. You paid the load fee. Compensate the salesperson, because we have some people working hard in buying and selling. It's like a compensation for them, for their working. It looks like the brokerage commission. Varies with dollar amount purchase. Load expenses mean investors pay a premium over the fund's net asset value. These expenses is like important for the mutual funds. The more expenses that paid, it means the increasing in the net asset value. It means there is a demand on underlying stocks or underlying security. So it's adding up to the total value of the assets. You know this. It means these fees indirectly increase the net asset value of the underlying security. No load mutual funds. There is no. The salesperson receive no fees or no charges. Okay. Other fees and expenses. The exit fees, early withdrawal fees. This exit fees, for instance, if you buy, and at least you should hold your security for 6 months. If you liquidate your security before 6 months, you are subject to the exit fees, and you are subject for different style of tax. Because as you know from the chapter 4, they encourage the long-term investment. Yes. But if you violate this rule, it means you are subject to high fees and high tax. You see the beauty of investment. If you are smart, you can. And you are smart. Management fees. Management fees, it's important because some people sitting, okay, with the glasses, they have a lot of information, they have their own experience, they have their own networks, and we should compensate them for their invisible hands in collecting information and giving you advice and recommendations. Okay? And if you compare between the expenses that you paid and the total benefit that you obtain, the total benefit is inflated relative to the fees that you paid. Your $2, how much you will pay as if you want to invest $2 in McDonald's is nothing. But with these people, okay, they welcome your $2, and you don't need to pay for at least for the early stages on your investments. It's like make people to enjoy. Operating expenses, is related to the management as well. A 12p1 fees. A 12p1 fees is related to the marketing securities. Mutual funds portfolios. Within the mutual funds, just to remind you, this is the investment company. Then we have the mutual funds. And in the mutual funds, they are forming different portfolios with different objectives and with different strategies and policies. If you have $100 and you don't have investment company or either the mutual funds, you cannot classify or diversify your portfolio. But within this mutual funds structure, you can easily find your style of investments.
Yes.
So make classified by type of investment. When I say type of investment, it means the classes of investments. You either invest in the stocks, in bonds, in foreign exchange, in metals, in the. Let's give you an example on here. We have, in last week we observed the dollar is going up, and when the dollar is going up, we observe other securities is going down. So the idea of this, the stocks or the financial asset or real asset or within the financial asset, they moving sometime together or against each other. So the different investment classes giving you opportunity to invest in different categories and in different movements. Okay? So when we talk about investment types, it means all of the investment classes, including the real investments. When we talk about investment style, it's related to the investment philosophy and strategy. Okay? So we have two different concepts related to the investment classes and related to the investment strategies and policies. Give you example of the investment style. You have example of investment style, strategies, philosophies. Okay, for instance, we are Muslim, and you may ask, okay, I'm not invest my money in companies producing wine. This is philosophy. Okay. For the strategy, you said, okay, my strategy is to invest in growing companies or in the dividends or the income companies. Be careful what I'm saying. The income companies is not as same as the growth companies. Yes, income pay dividends, but the growth company, no dividends. You see?
Yes. Like Google.
Okay? So this chapter, unfortunately, this chapter is connecting many things together. So if you don't understand the previous chapter, please, okay, have a cup of tea or a cup of coffee and sit down, okay, and read carefully. And switch off all of the Twitters and Facebooks and all of these things. Sorry? Otherwise, you will get lost. That's my recommendation, okay? Another example of the investment style and the strategy. Some people, they prefer to invest in small companies. Others, they prefer to invest in large companies. So these are examples of style. And again, a lot of questions on the style. And okay, we will stop here. Okay. Then we will talk, inshallah.